Hello, this is Dr. Oz. In this video, quickly, I would like to show you my opinion about Walgreens. And again, I'm not looking at any other things other than free cash flows that the company generated. So what I did is I went to Capital IQ and then click on income statement. And then here I chose annual because annual is more than enough for me. If you want to use with quarterly data, that's fine. I will use annual data. And I like to see all data that's available for me. And then I click on download financials. That takes some time. And then once you got that, it's downloaded, you can open it up and you will get these tabs: key stats, income statement, balance sheet, cash flow statement, multiples, and so on. But I create a new sheet here and I can share this Excel file with you guys. And my first row is I create the base year based on historical data. And then I try to forecast next 10 years. And then after 10 years, I will assume that the company will be stabilized and will continue to do the same thing over and over again. I look at the historical data for 10-year US bond rate, and you can see the website. And here there's a note. Currently it's 1.6%, but it's extremely low. I'm based on historical data, again, I assume this value will go up maybe to 250. You could go 350 even, but based on the slow economic growth and low inflation rate in the United States and Europe, and I don't see this value going up so fast. And as you see, I increased this from 1.6% to 2.5% gradually, and you can see my formulas. Then I went to Yahoo Finance for Walgreens and look at their beta coefficient, and looks like it is 0.86. S&P 500, which is the market, is 1. That means that Walgreens has lower standard deviation in terms of volatility. So I assume that that will be the case for the future. I look at historical data for S&P 500, which is the market, last 10 years, 20 years, 30, 40, 50, and even 100 years. Looks like in general, if you are a long-term investor, you should be able to get 8 to 10% dividends reinvested. So that's why I put expected market return as 9%. And then I calculate expected return for Walgreens based on the risk-free rate, beta coefficient, and expected market return. And obviously this number is less than 9% because again, the risk of Walgreens is less than the market because of the beta coefficient. Then I look at the income statement, most recent years for the company, Walgreens, which is right here. And I create the row here, right here, row 37, interest rates. And I look at the most recent data for interest rates, and I took the average of those most recent data. And you can see the formulas again here. So around 3.24%. I assume this is going to go up to 5% because, again, if the risk-free rate goes up, interest rate should go up in the future as well. And then I look at the tax rate, effective tax rate that they pay. Again, I went to income statement, row 88, and most recent years, I took the average of that. Looks like they are paying around 17% effective tax rate. So this is my 1 minus T, which is going to be my tax shield effect, will be considered by this. And then I look at their debt to total company value, enterprise value, and that's around 47%, and 52% is the market cap to the enterprise value. Then I calculate the weighted average cost of capital based on the equity holders' expectations versus lenders' expectations. That end up being around 5.5%, and this changes based on the numbers discussed above to 6.27%. Based on WACC, I calculate the discount factor, and you can see, for example, here that if Walgreens generates $100 10 years from now, it's only worth $54.33 today. And then I look at Walgreens, again, income statement tab right here, most recent years and last 10 years, looks like they grow 8%. If you look at the last 5 years, more 13%, but I think there's 1 year that their growth revenue increased so much. I can show you. I think that's not sustainable. That's why I did not use last 5 years. I use last 10 years. You see here in 2015, their revenue increased by 35%, but that's not the case in general if you go longer term. Okay, so that's why I use last 10 years average here. It's around 8%, and I assume that that will go down. Eventually, they will become so big that they cannot grow forever. So 2.5%. Then I look at their EBIT, earning before interest and tax, to understand company's efficiency and the change in EBIT. Those are the things that I look at it. So if you look at income statement, all these green rows, those are the ones that I created. So you can see the EBIT, their earning before interest and tax, margins are 4 to 5%. And actually it's declining. Looks like there is a big competition in the market. So around 3.8, almost 4% decline in EBIT change. I assume that this eventually go to zero because it will stabilize. Then I look at the company's free cash flows from the cash flow statement, and looks like this company on average is generating around $4.3 billion, $4.4 billion. And I expect this to grow by free cash flow growth rate that I came up with based on revenue growth rate and their efficiency measure, EBIT margin percent change. And so I expect this Walgreens to have around 2.5 to 4% free cash flow growth in the future. And based on that, these are my future expectations about free cash flows of Walgreens. And then I discounted these future cash flows, expected future cash flows, based on discount factor that I calculate based on weighted average cost of capital. And then I add all those expected future cash flows up, and subtract all the debt that they have, total debt that they have, and edit all the cash that they currently have. So according to my calculations, their intrinsic value of Walgreens is $87 billion. And if I divide that with balance sheet number AH76, which is number of shareholders, shares outstanding, I think the company is worth $98.58 per share. So I like to have margin of safety. That's why I say 20% off, buy signal for me. If it's 30% or more or off, cheaper than intrinsic value, I say strong buy. And similarly, I say if it's 20% more than intrinsic value, the current price, sell. And then otherwise 30% or more, strong sell. Anything between these two values, buy and sell, is called wait. Then what I did is just Google the Walgreens current stock price is $53.24. And if you look at it, that is below my strong buy signal. So I think the currently stock is traded at 54% of the intrinsic value. So I think this is a great buy based on numbers. Again, I haven't done thorough analysis about the company in terms of their products, the competition, but my understanding is people are scared of Amazon, Walmart, and Berkshire Hathaway attacking the field. So it's just kind of a competitive market. I understand that. But if we conduct our thorough study and we don't see any issues, I think from free cash flow standpoint, Walgreens could be a great buy option. That's my humble opinion. And please feel free to give me your opinions about this. That's it for this video.